Hi, today is day 6 of our debt reduction video conference series. And today it's all about education. It's all about financial literacy. So I want you to commit to learning the ABCs of money that we all should have received in high school. I'm going to show you a few things, but the first thing I want to tell you, again, my own personal story. So it sounds quite magical if I say, oh, I figured out the Thrive budget and I moved in with a single mom, and, that didn't last forever. And then I said, oh, and I tripled my money by investing in stocks. Well, that didn't happen like I invested and it just went up and nothing traumatic happened. Actually, what happened is I invested a lot of money August of 2001. That was the month before 911. And so when 911 happened, I had to research in order not to freak out. So that's what I want to tell you, is that you cannot replace financial literacy with just a financial partner. Even if you choose to have a broker, salesman, financial partner, you still have to educate yourself. Sorry, I'm in New York right now. Anyway, you still have to educate yourself, because something like 911 happens, or the pandemic, or the Great Recession, then your stomach acid's going to kick up and you're going to freak out and you're going to want to sell low. And whenever the markets are super high, you're going to feel like you're invincible. You're going to be like a teenager again, where you know everything. And you're going to not want to rebalance and capture your gains. So the nest egg pie chart system is a buy low, sell high system on autopilot. It is foolproof as long as you do it. Okay, so let me show you how that works first. Okay, so let's say that we are on my nest egg pie chart system. And again, you now know that all you have to do to get this free web app, which is going to take us less than 5 minutes to do, is to go to nataliepace.com and click on the badge. We will email you that free web app, okay? Or you can email us at info@nataliepace.com, and that we can email it to you that way. Okay, so you start with your age. So let's say that you're 30 years old. And we're going to have a 7% GDP growth in the US this year. So we're not going to overweight anything safe. Our annual income is about 100,000 a year. And let's say you have already saved up 80,000. Or let's put it at 90,000. Now, click submit, and your pie chart says, hey, at your age, you always want to keep a percent equal to your age safe. So we're going to keep 30,000. If you're depositing 10% and you already had 90,000, then you're going to have about 100,000 by the end of the year, because 10% of 100,000 is 10,000. And that's if you didn't make any gains. Now, if you're making a 10% gain, then you'd have about 110,000, okay? But let's say that you just have what you contributed and what you started with. And so keeping a percent equal to your age safe means you keep 30,000 safe. Again, I have a whole chapter in the ABCs of money dedicated to what's safe, which you need to read. But for now, let's say FDIC insured cash. Getting safe is beyond just having FDIC insured cash. It's a 2-step process. And again, there's another couple of chapters that deal with that as well. But let's say the first step is FDIC insured cash. Then the rest of it can be invested, and you can have 10 funds, and each fund is going to have about $7,000 in it. Now, the beauty of this system is that when you rebalance it again at let's say you choose April 30th of 2022, right around the time when you're doing your taxes, then, or after you've just done your taxes, then if you have a slice that should be 7,000, that's now 14,000, then you know that you need to sell half of it and trim it back. That's selling high. Your whole nest egg is going to be bigger if you had a slice that doubled in value, right? So you would have then, instead of 100,000, 107,000. If you had all of your 10 slices doubled, then you would have a substantial amount more, right? You'd have 140 plus your 30, and then you have 170,000. So your nest egg would be much bigger. Your slices at that point would actually be slightly bigger too. So what you do once, twice, or 3 times a year is you're going to don't work off the brokerage statements, because they are going to prompt you to do the wrong thing. If you see something that's gone way up, it's going to be in green and it's going to have a plus sign, which means go, 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 right? But in actuality, it might be a good idea to be selling high. Not everything. It's not all or nothing. It's a pie chart system. And if it's gone down in value, it's going to have a minus sign. It's going to be in red. And you're going to be thinking, oh my God, that sucks. Maybe I should sell that sucker. In the pie chart system, when you pull it off the brokerage statements and you see the slices, they help you to do the right thing. So the brokerage statements are prompting you to sell low and buy high, which are the wrong way, because when it's going up and it's in green, you're thinking, wow, I should buy that. When it's going down and it's in red and it's got a minus sign, you're thinking, ooh, that sucks, I should sell that. So the pie chart system, when you pull it off and you put it into the pie chart system, something that's gone down in value is going to be a smaller slice. And it's going to say, hey, maybe you should buy low on fill up the slice. If you have a slice that's gone way up and it's bigger than it should be, it's saying, hey, you should sell high and trim this back to where it should be. So the pie chart system takes the emotions out of it and is a buy low, sell high plan on autopilot. Again, you're going to want to learn more about it by reading the stocks and what's safe sections and the real estate sections of the ABCs of money. And you can also learn about it at the retreat. We spend 3 days and it will transform your life to get the financial foundation you need for your financial house to withstand economic storms. And we have, even though it's going to be an amazing GDP growth year, we do have some financial storms on the horizon that you should be aware of. So let's go back real quickly to our pie chart, because let's say, for instance, all of our slices doubled and now we have 140,000 in our slices plus our 30,000 that we had safe, and that means that we have 170,000. So again, it's easy to do because now your liquid assets, instead of being 90, are 170. And your slices, if you're not overweighting anything safe, are now going to be 12,600. So if you had $14,000 in each slice, then it's not saying go down to 7. It's saying, okay, let's trim them back to 12,600 now. And let's keep 54,000 safe, which is a third of it. Now, the other thing is, again, if you're worried about too many economic storms on the horizon, overweight a little bit safe. Overweight 10% safe and pretend you're a little older. So again, you're still going to have that third because that's your age. Here's the overweight safe here. And then your slices are now 10,800 instead of 12,600. If you wanted, there was a time when we were overweighting 20% safe because this was incidentally right before the pandemic. And at that time, you would have had, if you were 30, you would have had 50% safe. And that would have been very good because during the pandemic, let me pull up the chart for you. I think it's this one. The markets dropped 35%. So when everybody else would have lost 35%, instead, you would have lost 35% of half of your nest egg. So this overweighting safe, if it really looks like we're either at a market high or there's a lot of peril out there, or overweighting 5, 10, 15, 20% safe. I wouldn't do more than that. That's something that you can do based on market conditions. Now, again, if all of this sounds too crazy for you, then again, it's easy as a pie chart. So we answered 4 or 5 questions, and don't go crazy paralysis by overanalysis. Say, do I think I should overweight anything safe? Do I feel like I want to, like I'm worried, then the answer is yes, you should overweight something safe. If you're not worried at all, then no, don't overweight safe. Okay, so when I did mine, again, I told you I did it in the Great Recession. I mean, sorry, the .com. So I had purchased in August, so that would have been right around there, not at the exact bottom that happened at 911, but very close. What you see here is that the markets had already dropped substantially by August of 2001. And that is why when I purchased, it was at a very low price. One of the stocks had started out at $12 a share in April of 2000. And by the time I purchased it, it was $1 a share. So I was getting a great price. And after I did my research and I realized that after a shock like 911, the markets often rebound. This has a lot to do with the Federal Reserve Board. I decided that I wouldn't freak out and I'd just wait and see where it was in a few months. And lo and behold, I looked at it on December 27th and I tripled. Now, after 911 and with all of the other peril that we had, it seemed very likely that we would have a continued recession. And so I did take a lot of gains and I did overweight very safe after that. So that's, again, it's not like I was as educated and confident then. I was instead informed and doing my research. And that's part of why I love my job. You may have a job where you don't have the extra time to do the research required. Come on my monthly free video conferences and ask a question about it. Send us a question. It may be that I've already written a blog on that or that I want to write a blog on that. So I'm going to show you a few more things here. Sorry, just one second. Pull up the screen again. So in the .com recession, .com stocks lost 78%, and it took 15 years to come back to even. In the Great Recession, stocks dropped 55%, and it took 8 years to crawl back to even. This is not normal recessions. That is why I say that buy and hold is a last century strategy. In the last century, we did not have recessions that dropped so severely and took so long to recover. So buy and hold worked better in the last century because we had an economy that was growing. In this century, we have fueled our economy with low interest rates. Low interest rates create asset bubbles, bubbles in housing. So think about it for a minute. What happened before the .com recession? A bubble in .com stocks. What happened before the Great Recession? A bubble in housing stocks. And what happened before the pandemic was that we had a high amount of leverage, even before the pandemic. So when the pandemic hit, within days, the economy had to be absolutely rescued. So here is January of 2020. And again, I'm comparing it to before the recession, before the .com and the Great Recession. You can see that we were already, before recessions, we usually have very low unemployment. Housing prices were elevated, so we had a bubble-ish in housing. Now it looks like, since housing is so much higher, it looks like, oh, well, maybe that wasn't a bubble, but honestly, it is unaffordable. And we can talk about housing in one of my free video conferences, monthly video conferences. Consumer debt was higher than it was before the Great Recession. Public debt was absolutely astronomical. Total loans and debt. So what we have now is a very leveraged economy, and it was so leveraged that, again, we didn't even know we were in a pandemic that was going to be this severe by March. And in March of 2021, bonds froze up, money market funds froze up, and so did Treasury bills. And the Federal Reserve had to have an emergency session and they had to open up the floodgates and start buying up things. So right now, this is a pandemic recovery. And this year, compared to last year, is going to look amazing if we don't have another resurgence. But we have a massive amount of debt that we have to cycle through. Over half of the S&P 500 is at or near junk bond status. And we still have a lot of industries that are having a structural shift, like commercial real estate, malls, office buildings, airlines, tourism, Airbnb. A lot of these things are going through a structural shift. So you really need to know what you own. And again, if you just get the funds, if you just do small, medium, large, value and growth, and you're not, confident in your fund picking, just the fact that you're properly diversifying and adding in 4 hot industries. If you like cryptocurrency, have one slice. Don't do everything on it. A lot of people were just overdoing it on crypto and they bought high and they're now down significantly. So the slice system can protect you from yourself. If you like cannabis, have a slice of it. If you like technology, have a slice of it. And again, we can teach you more about how to really fine tune the system at the retreat. You can learn a lot more about how to fine tune the system by reading the books. Or if you have wealth to protect, then you should get a second opinion now. So the bottom line here is you got to commit to the financial education. You have to be the boss of your money because there are a lot of brokerages and broker salesmen that are still using buy and hope. And the reason for that is that is their monetization model. That's their profit model for their own business. It's not because it works great. The reason that I have the enthusiastic recommendation of a Nobel Prize winning economist is that we could see it back then he wrote the foreword to my book. He wrote it in 2006 before the Great Recession, but we could see it in the economic trends that we were really that modern portfolio theory with annual rebalancing, the Thrive budget, that these things were going to be essential to surviving in today's world and thriving in today's world. So yes, remember that when you think about a debt problem, the solution is actually 2 simple things. The devil is in the details. You have to increase your income, and by investing 10% of your income in tax-protected retirement accounts and learning how to earn money while you sleep, you're increasing your income without taking on an extra job, and you're increasing your income in a way that is not taxed, which is an important part of the solution as well. The second thing is you have to reduce your expenses, and that's what we're tackling through the Thrive budget by saying, look, if you eat out every single night avocado toast, then yes, that's a problem. If you have Starbucks every single day, then yes, that's a problem. But you're going to only save hundreds, maybe thousands if you're both avocado and Starbucks addicted. But it's the big ticket item. You need to learn how to save thousands annually. And that's going to be through housing, medical insurance if you're an American, transportation costs, that sort of thing. That's where the magic's going to lie. All right, I'll see you tomorrow, and thanks for joining me.